All of a sudden, Cameron, we're comfortable with 290-ish on a US 10-year. That's quite a change.
Well, I think it's not altogether surprising. If you think that inflation is sort of, making a bit of a comeback, we're sort of morphing to a late cycle phase. And in a late cycle phase, I think you would expect the positive correlation between stocks and bonds to sort of reverse a little bit, because you're leaving a liquidity regime and you're moving towards more of an asset allocation regime. And the choice is, do I own stocks or do I own bonds? And that sort of reverses the correlation. So if stocks go up, you would normally expect over time bond yields to rise as well, and vice versa.
Eric?
Yeah, look, I would agree. I mean, you think of a typical 60-40 portfolio or even a risk parity portfolio, the whole concept is that stocks and bonds go in different directions. But, if we're in a deflationary risk-off period when stocks are falling because of a risk-off, then typically treasuries rally. But if the pressure in the stock market is because of higher rates, and this whole episode of stock market volatility started 2 weeks ago when we had the higher than expected wage print and non-farm payroll, to me that really calls into question the value of treasuries from a diversification perspective in all market environments vis-a-vis an equity portfolio.
Well, Goldman's saying the following, calling the end of the Goldilocks scenario. A strategist running in a note, read the following. In 2017, a balanced portfolio of 60-40 had one of the strongest risk-adjusted returns since the 1960s, as bonds and equities went up together with very low volatility. So you do wonder what this means for the 60-40 portfolio, Cameron, because you don't get a bid in bonds when equities go down at the moment, and you know they're going to be travelling low when equities are going up at the moment. So I don't see what's going to happen here.
Well, I think there's still something to be said for it. In the sense that if you do, I think we're going to be in a phase where if you do see a sharp drawdown in equities moving forward, that should eventually prompt a bid for bonds. So you should get some diversification effect. But what you won't get is this idea that everything goes up at the same time. Frankly, the risk-adjusted returns that you've gotten from 60-40 over the last year or two are unrealistic. They're unsustainable. So, you shouldn't expect the next 2 years to look like the last 2 years.